What is up, Ladder Climbers? Antoine here from Elevate to the Unknown, the Way Report and NextGenHeights.com. And it is Wednesday, February the 11th, 2026, 7:25 a.m. Central, and we are live on the Daily Climb. I got one number for you this morning, and this number changes everything. 911,000. That is how many jobs may have never existed. Okay? 911,000. See that number right there that I'm showing you on the screen? That's a lot of jobs. In about 30 minutes, the Bureau of Labor Statistics releases the delayed January jobs report. And buried inside that report is the final benchmark revision. That could erase nearly 1 million jobs from the 2025 record. The job market that you were told was resilient may have been running at half speed the entire time. But that is not only what we're going to be talking about this morning. Google, they just told employees, get all in on AI or take a severance package and leave. Block, Jack Dorsey's company, just announced its third straight year of layoffs. 1,100 people gone. Retail sales came in flat for December, flat during the holidays. Wage growth just hit its slowest pace since 2020. And Spotify, they beat earnings by 63%, while Coca-Cola, they missed. The economy is splitting in real time. But all of that is the undercard. The main event hits at 7:30 in a few minutes. Today, we are going to find out the real numbers. This is the Daily Climb. I'm Antoine Wade. Let's look at the data, okay? But before we do that, let's see who's all in the house. We got the champ, Big Suggs in the house. We got the lieutenant, the Life of Cam in the house. We got Mr. Oliver in the house. We got Topaz in the house. Good to see you guys this morning. I love my regulars, the lieutenants, the energy, Big Suggs, the voice, all of you guys. Thank you so much for rocking with me this morning. We are going to have a fantastic show. Okay, let's go ahead and dive into the numbers because the data is going to tell us everything that we need to know. Let me start with what happened on yesterday, because corporate America just drew the line. Okay. The line was drawn on yesterday. And the message is simple: perform or exit. It's that simple. Google's chief business officer sent an email to staff on yesterday. His name is Philip Snyder. And let me read what he told his team. Okay? Let me read what he told his team. He told everyone in the business unit, and I quote, all in on the mission and embracing AI have even greater impact. Okay? All in on the mission and embracing AI to have even greater impact. Then he said this: if you are not enjoying the pace that we need to operate in, or if you are ready to move on from Google, we will offer you a voluntary exit package. Let me say that again. If you are not all in on AI, here's the door. Now, here's the part that you need to pay attention to. Who was offered the exit and who was not? Solutions teams, sales operations, corporate development. Those roles can take the package and leave. But customer-facing sales teams, the people who bring in the money, they are not eligible. You hearing a pattern there? Monday, I showed you the great rotation. Yesterday, I showed you Salesforce cutting 1,000 roles, including their own AI team and executives leaving. Today, Google is saying the same thing. Revenue generating roles are protected. Everything else is on the table. And this is not a one-time thing. This is Google's third round of buyouts in under a year. In June, they pushed out remote workers. In October, they restructured YouTube. Now, the business unit. I want you guys to type signal in the chat if you see the pattern. Revenue generators are protected. Everyone else is a cost to be managed. Okay? Type signal in the chat. All right? Now, this is not just me telling you this at all. We got videos on CNBC. CNBC sat down with the White House economic advisor, Kevin Hassett, 2 days ago. And what he said confirms exactly what Google is doing. I want you guys to watch this real quick, okay? Watch this video.
President Trump telling NBC News he's proud of the U.S. economy and that 2026 is going to be even better. Joining us right now is White House National Economic Council Director Kevin Hassett. Good morning to you. There's been a long sort of back and forth about the state of our economy, about how good it is, but also maybe how bad it is.
Jump to 315.
So, yeah, I absolutely believe that we're on an uptick that's significant. I think that the open question really is what's going to happen to jobs as productivity goes up? And I think that there's a chance that job creation lags. Productivity skyrockets, profits skyrocket, GDP skyrocket. But then all of a sudden, like you're making 20 widgets and you can make 20 widgets with a fewer person, and then that person has to find a new job. I think that kind of transition could happen.
When you think about last week in the markets, I don't know how focused you were on sort of the back and forth, but there really was a sort of the mood music. It seemed to change, if you will. For much of the week, there was a real concern about tech companies effectively overspending on one side, whether some of the big tech companies, which had been rewarded for their spending, were getting nicked, if you will. And then on the other end, there became worries about some of the other software companies and whether they were going to be cannibalized by the big guys. By the end of the week, things had shifted gears all over again. And how you're thinking about that and who you're talking to about it.
Yeah, I actually talked to a bunch of my friends in Silicon Valley over the week to try to understand what was going on. And the bottom line is that a software engineer at a typical, West Coast Silicon Valley company has seen their productivity go up by 50, 80% over the last year because of these amazing tools that Anthropic and the other countries are developing. And so what that means is that if you're a 22-year-old kid who just graduated from college with a software engineering degree, that there is a machine that can probably, help a senior person do your job. But
AI is making workers so productive, they do not have to hire the new kids. That is not me saying it. That is the White House National Economic Council Director, Kevin Hassett, on national TV 2 days before the jobs report. And Google just proved it. All in on AI or take a severance. Okay?
I didn't understand.
Now let me show you Block. That's Jack Dorsey's company. They own Square and Cash App. Block just announced they are cutting roughly 1,100 employees, about 10% of their workforce. But here is what makes this story different, okay? Here's what makes this one different. This year, which is year 3, in 2024, they cut about 1,000. In 2025, they cut 931. In 2026, 1,100. 3 years in a row. Same company, same time of the year, same playbook. Performance reviews hit. Employees rated below expectations, gone. Dorsey sent an email to staff. He said, and I quote, "We are behind in our actions, and that is not fair to the individuals who work here. When we know, we should move," end quote. Okay? Now, a Wall Street analyst looked at the numbers and said the savings from these cuts will likely be offset by hiring new people. Let me make sure you heard that. They are not saving money. They are replacing people, cutting the ones who did not perform and hiring new ones with different skills. This is the new annual review. Perform or exit. It is not a crisis. It is a system. And here is the data point that explains why. Blackstone's chief technology officer said this week, their software engineers are, quote, about 2 times more effective than they were in 2024 at writing code. That's 2 times more effective with AI tools. That is why companies can cut headcount, fewer people, same output, and sometimes more output. Yesterday, Salesforce, 1,000 roles, including their own AI team. Today, Google saying all in or AI or get out. Block on year 3 of annual cuts. Blackstone confirming engineers are twice as productive. The pattern is clear and undeniable. I want you guys to type Google in the chat if you have seen this kind of pressure at your company. Okay? Type Google in the chat. Now, before I move on, let me show you something that tells you just how chaotic this transition really is, even inside the biggest companies. Okay? Amazon, you know Amazon, we talk about them quite a bit on this show. They are a leader in their space. They're spending a whole bunch of money. They hire some really good people, and they have some really good products, and they have a really good business model. But they invested more than $60 billion in a company called Anthropic, the company that builds Claude AI that I always come to you guys and talking to you about because Claude is it. Amazon sells Claude code to customers through their cloud platform called AWS Bedrock. They want businesses to buy it. They want developers to use it. It is a revenue product for Amazon. But internally, Amazon will not approve Claude code for its own engineers to use on production work. Ain't that something? Crazy, huh? They're able to sell it, but they don't want their own engineers using it on production work. Instead, they are pushing their own in-house tool called Kiro and steering teams away from outside tools. So 1,500 Amazon employees endorse adopting Claude code internally. That's 1,500. Okay? And here's where it gets real. Amazon sales engineers, the people whose job is to sell Claude code to customers, they are asking, how do I credibly sell a product that we do not even approve for our own use? Okay? They can't even use it themselves internally, but they can sell it. Now, one employee wrote internally, quote, customers will ask, why should they trust or use a tool that we did not approve for internal use? Now, I'm not telling you this to make fun of Amazon. I'm telling you because it proves something important. If Amazon, a $60 billion investor in AI, cannot figure out which AI tools to use internally, imagine what it's like at the mid-sized companies. Imagine what it's like for some of you who are the smaller companies, have all these options. This is why your ability to navigate AI tools is a competitive advantage. The companies do not have it figured out at all yet. And if you can walk in and say, I know how to use these tools, I know how to make them work, you are ahead of the company that hired you. I want you guys to type Amazon if that story surprises you. Type Amazon in the chat. All right. So that is the corporate picture, the big corporate picture. Now let me show you what is happening to the consumer, because this is where the K-shape gets real. Okay? This is where the K-shape gets real. Check this out. Monday, I told you about the great rotation, money moving from tech into value stock. Yesterday, I showed you the reckoning, companies built on loopholes getting wiped out, all the pharmaceutical companies and companies like him and hers. Today, I'm going to prove to you that we are living in 2 different economies. And I have 3 data points that make it very clear. Okay? December retail sales just came in. The number, 0. Not up, not down, flat. Wall Street expected 0.4% growth. They got 0. Okay? And let me break down what got hit the hardest. December. Okay? We got department stores down 0.7%. Furniture down 0.9%. Clothing down 0.7%. Electronics down 0.4%. The only winner, building materials, up 1.2%. People are fixing their houses instead of buying stuff. And here's another number that really matters. Core retail sales. That is the number that feeds directly into GDP, down 0.1%. Consumer spending drives 70% of this economy. That's 70%. When consumers stop spending, companies make less money. When companies make less money, guess what they do? They cut jobs. An economist said it best, quote, high-income consumers are spending robustly, while those in the middle and lower income brackets are more hesitant. And that brings me to proof point number 2. Spotify reported earnings, and they did not just beat, they destroyed expectations. Earnings per share, $5.16. Wall Street expected $3.16. They beat it by 63%. 751 million monthly users. That is a record. 290 million premium subscribers. That is a record. Free cash flow for the full year, $2.9 billion. That is a record. The stock jumped 15% in one day. That's Spotify. Like, man, Spotify doing that good? I don't listen to Spotify anymore. I don't have Spotify. Insane though. Like, wow. That's something crazy, huh? Same day. Coca-Cola reported revenue miss, $11.82 billion, below what Wall Street wanted. Stock dropped 3%, and the CEO is stepping down. You see the split? Spotify, a premium digital subscription, serving people who can afford $13 a month for music, record highs. Coca-Cola, a budget consumer product, serving people who are watching every single dollar. They are missing targets. Two economies. The one that serves the wealthy is booming. The one that serves everyone else is stagnating. Think about the conversations we were having when United Airlines, healthcare, or Delta Airlines came out and talked about their records. What was booming? Premium economy, first class, in United and Delta. Well, the same thing is happening on the products. Premium products, booming, crushing it. Products that serve everyone else, stagnating. That's the K-shape. Type K-shape in the chat if you see this split in the economy. If you see this split in your own life. And if you think the K-shape is just a theory, let me show you what Mark Zandi told CNBC last month. Mark Zandi is the chief economist at Moody's Analytics. He is talking about the bifurcated economy heading into 2026. Okay? I want you guys to listen to this. Let me tee it up real quick. Check this out.
Our next guest says we're entering a new year in a bifurcated economy and that its growth is fragile. Joining us is Mark Zandi, chief economist at Moody's Analytics. I just want to say, Mark, Hasn't the economy surprised you in a positive way this year? There were so many calls, so many gloom and doom calls, especially around the Trump tariffs and what that would mean for inflation and for the economy. And here we are ending 2025, and it's been quite strong.
Yeah, you know what's weird though? I mean, I went back because I wrote this piece on the 2026 outlook, like most economists do, and I went back and looked at what my expectation was for GDP growth in calendar year 2025 as of December 2024. So a year ago, what would happen in 2025? And the GDP growth number was 2.2%. So, at least back in December of 2025 or 2024, I thought 2025 would be an okay year. But having said that, as we came into the year...
But would you have said that in April after the tariffs were announced?
No, that's exactly where I was going. Yeah, I certainly would not have. I would have thought that it would end up being a much weaker year, something closer to half that kind of growth rate, like a 1% growth rate. And the thing that, obviously, it's pretty obvious. The thing that was the big positive surprise was the impact of artificial intelligence, both, in terms of the investment spending, but most importantly through the run-up in stock prices and the wealth effects that's generated in the effect that's had on consumer spending. So you're right. As of April, I was much more pessimistic about the year. It ended up being much better than I anticipated.
So you say it's bifurcated. Is that because, in part, of the rising stock market, which has helped the wealthier cohort?
Yeah, in part. I mean, it's there's such a dichotomy. When I talk to folks, I get such a varied perspective on the economy. Some people are incredibly optimistic. Things are booming. Other folks are incredibly pessimistic. Things couldn't be worse. And I think that goes just to the fact that the economy itself is what the word is bifurcated. It's just operating on totally different levels. And you can see in lots of different ways. Large companies are doing great. Smaller companies, not so much. You can see that for example, in the ADP data. You can see high-end consumers, well-to-do, their financial situation is about as good as it's ever been. Folks that are lower income, middle income, not much. Industries. I mean, the tech industry, obviously, healthcare doing really well, adding a lot of jobs. But then manufacturing and the real estate industry, agriculture, transportation industry, they're literally contracting. They're in recession.
You heard him. If we are not in a jobs recession, we are close. That is the Moody's chief economist. And today, we find out if he is right, because the number has more than likely dropped already. Okay? And here's the third proof, though. Wages. The employment cost index just came in 3.4% year over year. Now, that does not sound bad until you look at where it came from. In late 2022, wages were growing at 5.1%, then 4.5%, then 4%, then 3.8%, now 3.4%. 8 straight quarters of decline. And here is the detail. Union workers are getting 4.3% raises. Non-union workers, 3.3%. The gap is growing. If you are not in the union, your bargaining power is shrinking. And when you adjust for inflation, real wage growth, 0.7%, barely above break even. So what does that mean? Employers have regained leverage. The days of 5% raises are over for most workers. If you have not asked for a raise or promotion in the last 12 months, your window is closing. Now, one more data point that might surprise you. Indeed's chief economist said this week, only 4% of U.S. job postings even mention AI. 45% of employers have zero AI-related postings. The AI transformation is real, but it is deeply uneven. Most companies are still figuring it out, which means if you figure it out first, you have an edge. All right? You just heard Spotify at record highs. You heard that retail's flat. You heard that wages are cooling. two economies running side by side. They like to call it the K-shaped economy. That is the context. Now, I'm assuming the job report, that number is out there. And that number is going to, in my opinion, rewrite everything that we thought we knew about 2025. Okay? Let me set this up for you real quick. Let me set this up. I want you guys to understand this. Because 8:30 Eastern, the Bureau of Labor Statistics releases the January jobs report. We already passed 8:30 Eastern, but this report was supposed to come out last week, but it got delayed because of the government shutdown. Now, here's what makes this report different from every other jobs report. It includes the annual benchmark revision. That is when the BLS goes back and correct its estimates using actual tax records. Okay? And the preliminary number from last year said they may have overcounted by up to 911,000 jobs. If that holds, 2025 did not average 121,000 jobs a month. It averaged closer to 60,000 jobs a month. I haven't looked at the data yet, guys. You guys are going to see the data with me today. The job market that we were told, and everyone was told, and everyone called resilient. If that's the case, it was running at half speed. Okay? Now I have a feeling, because when I started this show in 2025, you know, if you've been rocking with me for some time, I showed you the TikTok videos. We were covering the layoffs, the mass layoffs, the millions of people who were laid off last year, the people who weren't able to land a job after they were laid off. There was a large sentiment out there. A lot of YouTubers creating content about it. A lot of people in lines for employment. Now, Wall Street cannot agree on what today's number will be. Goldman Sachs says 45,000. Wells Fargo says 80,000. Citigroup says 135,000. The range is massive, which tells you economists genuinely do not know. Now, before we go to the live number, I want you to hear this from CNBC. CNBC's Steve Leisman sat down with ADP's chief economist last week. When ADP reported only 22,000 private sector jobs were added, they had a conversation about it. Listen to what she said about the pattern, okay? I want you guys to listen to what was said, all right? Let me tee this up for you real quick.
ADP private payroll data just crossing the wire. Steve Leisman's got the number. Steve.
Yes, 22,000, just 22,000, Andrew. We're looking for 41,000. Now, there may be some methodology changes that we can get into. We have Neela Richardson coming up. She'll probably do a better job explaining it than I will. But looking at it by sector, the goods sector up just 1,000. By the way, the estimate was for 41,000. 21,000 on the goods sector. Inside of that, manufacturing has lost jobs every month since March of 2024. The service sector, well, without that, we wouldn't have much going on. And the non-farm payroll estimate for this weekend, or that would have happened this Friday, was going to be 60,000, but we don't know when that's coming out. Looking at it by business size, small business has been extremely challenged since the Liberation Day tariffs. At zero, a goose egg right there. It had a slight gain last month, and it's been negative before that. Medium-sized business doing a little better, up 41,000, and large businesses shedding workers this time around, down 18,000. Looking at it by industry, again, it's the same economy we had before. Education, health services up 74,000, leading the way. Financial services doing well. Leisure and hospitality, not as well as it had been. But look at that construction. I wonder if that's picking up some of the data center construction. But professional and business services down 57,000. Pay gains, pay changes, annual pay, pretty much unchanged. Job stayers, 4.5%, unchanged from October. And job changers up 6.4%. That's down 0.2. Perhaps that's an indication of a slightly of a weak job market. Andrew?
Hiring is softening. It continues a pattern that we have noticed for the past 3 years. 3 years we've been talking about this. So this is not new. This is a trend. ADP's own revision erased 216,000 jobs from 2025. And in minutes, we're going to find out what the government revision looks like. The private data is weak. ADP showed only 22,000 jobs added in January. Challenger and Gray reported the highest January layoffs since 2009. 108,000 cuts announced. Job openings hit a 5-year low. Healthcare is expected to carry roughly half of all gains. Federal government is expected to be a drag because of the 249,000 net federal jobs lost in 2025. And one more thing. The CEO of a company called StatBlitz said this week he expects AI agents to outnumber human employees at his company this year. He said software stocks are repricing because AI can. And he said, quote, rewrite software 10,000 times faster. This is the backdrop behind today's number. Companies are betting on machines, and the jobs report tells us if the human side of the economy is keeping up. I want you guys to type jobs in the chat if you're watching these numbers, or if you probably already got a preview, type jobs in the chat. Okay? Type Wednesday if you are here live for the biggest report of the month. Okay? This is why we do the show. It's about the data. It's about understanding what's going on in the economy. It's about understanding what's going on related to your career, because it ties into everything. We spend so much time in our careers over our lifetime doing something for purpose, and we need to know what the data is telling us, especially in this time with this new technology. Now, it's not even new technology anymore, but this technology that we haven't seen that has superpowers. Okay. Before we go live, one more piece of context. All right. One more piece of context. Bank of America called today's report, and I am quoting here, the Super Bowl of jobs report. And the White House was so concerned about what is coming. They released a memo on yesterday titled, I am not making this up, guys. Don't be a panicking. That is what a memo was released saying, don't be a panicking. Here's what Hassett said about AI replacing workers. Okay. I'm going to jump over to CNBC, show you guys this real quick. See if I can tee that one up. Let's go to my man, Kevin Hassett. Uh-oh, we got the jobs report. We got it out already. Let's go to Kevin Hassett real quick.
President Trump telling NBC News he's proud of the U.S. economy and that 2026 is going to be even better. Joining us right now is White House National Economic Council Director Kevin Hassett. Good morning to you. Morning. There's been a long sort of back and forth.
Let's go to 45. See what he's talking about.
I mean, yes, of course he does. Haven't recovered. So, for example, excuse me, there's a big truck going by all of a sudden. So, for example, there was 20-something% inflation, and we've got inflation way down. Incomes are up. Real incomes are growing, but we haven't filled the hole from the inflation. So is it Trump's economy or Biden's economy.
Right.
I think that at some point that's you need to just like slow down and say, okay, so when we're talking about whose economy it is, that whose economies whose economy is the policy being driven right now? Who's going to manage the policy going forward? Who's going to give you the State of the Union in a few weeks that says here's what's going to happen over the next few months and years? And for that, it's definitely Trump's economy.
Kevin, one of the things that we haven't talked about since I don't think we've seen you since Kevin Warsh was
Davos
announced.
is the last time we
Right. So, but now, so now Kevin Warsh is going to have the job. Obviously, has to get through the confirmation process. But you know, one of the arguments he's made quite publicly is actually that because of AI and the idea of productivity, that there's an opportunity to lower interest rates, and that you can do that without increasing inflation. At the same time, there's now this new question about what's happening with employment in the country. And I'm curious how you think about squaring those two circles, if you will.
Right. I mean, there's absolutely no question that we're in the biggest productivity boom that we've seen since the 90s, that the introduction of the internet and the introduction of artificial intelligence are very similar in the ways that they're affecting the data. I thought it was interesting. You put up a graphic a minute ago where you showed that the biggest outperformer of the Dow was Caterpillar, of all things. But that's 100% consistent with what we're seeing, which is that, first of all, that Trump's tax policies are making it so that you can expense capital equipment. So there's big demand for Caterpillar stuff. But then also AI is making it so that every company from Caterpillar on up is finding that it's more productive when it does stuff.
Firms are finding that AI is making their workers so productive that they do not necessarily have to hire the new kids out of college. Okay? The White House is telling you AI is replacing entry-level hiring. It's making seniors do the entry-level work, and the jobs report is about to confirm it. Okay? It is 8:04 a.m. Central. The real number is out. Okay? We're going to dive into it. I want to see what it says. This is an important part of the show. Let's see if CNBC is talking about it. Let's see. Let's see what they're saying about it, the jobs report of today. And this is going to be interesting. I'm going to jump over to Business Insider as well, because they were going to be covering this one live. And I want to see what they have to say about it as well, because Business Insider is a great source. Okay. Wage growth stayed consistent. Wage growth remained consistent year over year, rising 3.7%. January 2025. That's in line with economists' predictions and comes after a 3.7% increase in December. Okay. Jobs growth was much lower than last year than previous reported. This is the one that we were just talking about. Annual revisions in this month's jobs report showed a big downgrade to job growth in 2025. The revision showed that only 181,000 jobs were added across last year, down from the initial reported 584,000, indicating an even slower labor market in 2025 than we originally thought. Those revisions are based on reconciling the monthly survey of businesses that generates the headline job growth numbers with more comprehensive but less timely data from the administrative records. Job growth was much lower than last year than was previously reported. Ain't that something? We figured it was going to be the case. We figured that was going to be the case. Here's a report by Madison Hoff. Job growth and unemployment beat expectations. The job market was strong in January. The U.S. added 130,000 jobs in January, far surpassing the forecast of 65,000. Unemployment unexpectedly fell from 4.4% in December to 4.3%, just below the forecast. So that's good signs, guys, at the beginning of the year. Jobs, people were hired in January of 2025 or 2026. I've seen a lot of people on LinkedIn just got hired, moving jobs and so forth. So maybe things are starting to change. But that doesn't tell us but we had a good sense of the data from 2025 based on this big, massive revision. Okay. The revision showed only 181,000 jobs were added across all of last year. If you divide that into what, 12 months? I'm like, that's how many jobs a month? Let me add that up, guys. Let me do the math. You guys are faster than I am with the whole math thing. Divided into 12, that's an average of 15,000 jobs added per month. No wonder people were hurting last year. No wonder there were so many articles in the career section of Business Insider and people not being able to find jobs. Only 15,000 jobs were created in a month. Every month on average. Crazy, huh? Crazy. The number is out, guys. You guys got it. You guys got it. Let's see.
Hi, good morning, Kelly. Yes, it's Jobs Wednesday. Not necessarily a Friday, but every bit as important. Non-farm payrolls for January coming in twice expectations at 130,000. 130K. That would be the juiciest going back to April of last year when it was 158. Now, if we look at a couple of months worth of revision, they came in at minus 17,000. Now, let's look for average hourly earnings month over month, up 0.4. That's 1/10 higher than both looking back and looking forward. 0.4 would equal October last year. You are all the way back to the summer of 24 to find a higher month-over-month earnings number. Let's go year over year. 3.7 exactly as expected. 1/10 light to 3.8 in the rearview mirror. So how does that stack up? 3.7 would be the lightest since it was actually 3.6. Thanksgiving of last year. Now let's look at hours worked, shall we? 34.3. That increase, that's a good thing. That's up 1/10 from both what we were expecting and our last look. 34.3 would equal November. To find a higher one, you're all the way back to March of 24. Now the unemployment rate, maybe the most important number of all, and it moves down 1/10. 4.3.
Went from 4.4 to 4.3, guys. We might be heading in a good direction in 2026, you know? They were saying at one point in time, there needed to be a reset. Maybe 2025 was the reset. Then they said 2026 was going to be the year. I hope there's a whole bunch of spending that's being done on AI. Billions and billions of dollars being spent on AI. It's creating a whole bunch of jobs for certain industries, which is the reason why we have to show. Okay? All that money is going towards something and going towards somewhere. Be a part of it. Follow the money.
Percent, all the naysayers out there, they're going to like this set of data points. 4.3 will be equal to where we were in August of last year. To find a lower number, you're looking at June of last year. Labor force participation moved up as well. More good news, 62.5. That would be the best since it was 62.6 in April of last year. And drumroll, please, the final number I'm going to give you is U6, the underemployment rate, and it comes in at 8%. 8%. Last look was 8.4. 8% would be the best going all the way back to July when it was 7.9. Now, for the bad news, but expected bad news, we're looking at benchmark revisions from April of 24 to March of 25. The original number that we were looking at was around minus 900,000, comes in at minus 862,000. So the benchmark revisions are a little less than expected, but some were actually thinking it'll be in the 700,000 camp. So that comes into minus 862. What are yields doing? Zoom, zoom, zoom is what yields are doing. We move from 4.
He's hyped. He's hyped. He's hyped like we're on the other side of this thing, guys. That's going to be the message. We're going to find out. If you stop seeing a whole bunch of layoff news, or let's just say that continues. Let's say the layoff news continues because companies are going to continue to do that. They're going to recycle people. But if you stop seeing people making TikTok videos of them going through hard times, then you're going to know. You are going to know that things are starting to get better. If you start to see more videos of people buying real estate, buying rental properties, taking vacations, you start to see the overall airlines, starting to hit record revenue again outside of just premium economy and the first class, and you're going to start to see people are doing pretty well. Okay, when is that going to hit? I don't know, but we're going to track it here on this show.
Or 12, which was down 3 on a 10-year to 419. That makes sense. A 2-year really screaming from 345 all the way up to 353. Why? Because these are solid data points. And one more thing I'd like to point out. I am really on this kick. I think seasonal adjustments are dead on arrival on most numbers. Yesterday's retail sales looked flat. I brought it out at 8:30. But if you look at non-seasonally adjusted, it was the strongest December on record at $818 billion. Kelly, Sully, back.
Interesting report, guys. What's your guys' take on this? Put it in the chat, okay? I want to know your guys' take on the jobs report. This man was hyped. He was very, very hyped. And that's his, the data is going to tell us a good story. Data is going to tell us a story, whether it's good or it's bad. Let us continue on, though, okay? We've covered the corporate picture. We've covered Google saying get all in on AI or get out. We've covered Block on their year 3 of cuts. We've covered Amazon, who's confused about its own AI tools to use and how they should use them internally. We've covered the consumer picture. Retail is flat. Wages are cooling. The K-shaped economy is confirmed. We just got real numbers on the labor market. January was a pretty good month. Okay. Now let me show you where the money is actually going, because the money will always tell you where the jobs will be. Okay. Let's look at Robinhood. I want to start with this company that is doing the opposite of what everyone else is doing. Okay. Robinhood just posted record fourth quarter revenue. $1.28 billion, up 27%. Full year revenue, $4.5 billion, up 52%. That's a record. 27 million funded customers, up 7%. 324 billion in platform assets. That is up 68%. Gold subscribers, 4.2 million, up 58%. And here's the key. Robinhood is one of the few tech companies right now that is actively hiring. They're hiring in engineering. They're hiring in product. They're hiring in compliance. They're hiring in international expansion. Okay? Now think about that. The same industry as Block, the fintech industry, same sort of market conditions with regulations and crypto and investing and all sorts of stuff, right? But Robinhood is growing in hiring, while Block, it's on its 3rd year of cuts. What is the difference? Revenue diversification. Robinhood makes money from options trading, from equities, from interest income, from subscriptions, from crypto. Block is dependent on Cash App, one product, one revenue stream. When you have one product and that product slows down, guess what you do? Well, you cut people, and you cut people every year, like clockwork. When you have 5 revenue streams and one slows down, the other 4 keep you growing. That's revenue diversification. And revenue diversification equals job security. Single product dependency equals annual layoffs. That applies to company and it applies to you. Okay? Think about this as you are potentially on your entrepreneurship journey or whatever it is. You got to understand that single product dependency always equals higher risk, always equals potential layoffs if sales are no longer going. Okay? If your career depends on one skill, one industry, one employer, you are blocked. If you have multiple skills, multiple revenue streams, multiple options, you are Robin Hood. And here's why revenue diversification matters. And it's not just for companies. It's also for careers too. Coca-Cola CEO James Quincy just did an interview on CNBC where he called the revenue miss a weird anomaly. Okay? A weird anomaly. I can't even say it. Anomaly. A weird anomaly. But I want you to listen to what he said about growth. Okay? I want you to check this out. I'm going to share this with you. James Quincy on CNBC. Let's jump over here real quick. They wouldn't charge me. CNBC wants to charge me for the interview, okay, on James Quincy. We're not going to do that right now. No, CNBC. Let me see if I can find a Coca-Cola interview. My link broke. Let's see if we can find it. There we go. I found it. Check this out. Oh, no, you're not going to charge me. Okay. We're going to miss this one today until I get my account set up. All right. We'll do that at some other time. But I got a chance to listen to what was said. And what he said was a weird anomaly. Okay. When there was a revenue miss. Okay. But the stock dropped 3% and the CEO is stepping down after the shareholder meeting. The market does not care about anomalies. The market cares about results. Okay? Same applies to your career. Your employer does not care about anomalies. They care about your output. And this is why you need the 2026 Career Protection Playbook. Okay? CVS and Aetna, the healthcare pivot. All right. Now, let me show you the other side. CVS, they just cut 113 insurance jobs at Aetna, part of a $2 billion cost cutting plan. All right. The roles being cut. Guess what? The roles are being cut. Sales reps, underwriters, account managers, plan operation staff, from analysts all the way up to the executive director level. They are shutting down their small group insurance business and exiting the individual exchange market. But here's what they are not cutting. Medicare Advantage, Medicaid managed care. Those segments are growing. And the companies hiring in those segments are United Health Group, Elevance, Centene, Molina Healthcare. They are all adding thousands of people in Medicare and Medicaid. So if you are a small group insurance, if you are in small group insurance right now, or working at an individual exchange, the skills transfer to the Medicare Advantage is a direct skill transfer. You already know the business. You just need to learn the government payer rules. And there are certifications for that. I want you guys to type healthcare in the chat if that's where you're going to be pivoting. Okay. Now, I want to bring this together real quick because I built something for you guys. I just talked about it a second ago. Now I'm sharing it on the screen. I've been doing this show for every for the last 7 months, every weekday morning, breaking down the data, showing you the stories, giving you the strategies. And I keep hearing the same question: how do I actually start? So I'll put it all together for you for free. The 2026 Career Protection Playbook, business intelligence translated into career strategy. Today, we showed you that Google is telling employees, use AI, get on the AI train, or take a severance. Block is on its 3rd year of layoffs. Okay. Laying people off who do not perform. Blackstone says engineers are twice as productive with AI. The playbook helps you figure out where you stand today. And here's what's inside: how to know your risk zone for AI automation. Are you in the full automation bucket, the augmentation bucket, or the transformation bucket? The playbook shows you how to find out. The 5 skills that actually matter in 2026, not a list of 50 things, just 5. The 5 that the data says employers are paying for right now. And it also includes a 30-day quick start action plan, day by day, what to do, what to learn, what to apply for, so that you're not guessing. It also includes a weekend action plan with 5 specific moves, 5 things that you can do this Saturday or Sunday to start positioning yourself. Okay. And on top of that, you get the Daily Climbs newsletter delivered to your inbox at 11:30 a.m. Central. Okay. Monday through Friday. Everything that we cover in these shows, the data, the stories, the strategy, straight into your inbox. The professionals who survived in 2026 are not waiting for permission. They are building career insurance right now. The playbook is absolutely free. Click on the link in the description and go and grab it. Okay. And if you want to go deeper, we have a community for you. The Patreon is where you're going to find the life of Cam, who's greeting you guys when you come in. Big Suggs, who's greeting you guys when you guys come in. It's going to include some wonderful individuals, high energy people who are absolutely doing the things that we need to be doing in order for us to separate ourselves in this kind of a market. I want to be on the top of the K side. Okay. I don't want to be on the bottom of the K. I want my premium. I want to buy more premium seats, more premium, head in premium economy. Buy the luxury. Well, that's what you do in your career when you position yourself the right way. Okay. And that's what we are doing and what we're working on inside of our Patreon community. Inside of it, you get the full opportunity map, specific companies, roles, salary ranges. Plus, you get to join a Saturday call, 7 a.m. on Saturday morning. We do live AI discussions, live demos, showing you the work that we are putting in. Patreon.com/Black Heights. Link is in the description of that as well, too. Okay. Let me bring it home. I'm pretty excited about the jobs report, guys. I don't know about you. I'll get your opinions pretty soon. But let me leave you with 3 takeaways from today's show. Takeaway number 1. The real number is out. And it rewrites 2025. We saw the jobs revision, the benchmark revision. Okay. The labor market was weaker than we were told. If you've been told that the job market is resilient, the revision from 2025 shows you that it was absolutely weaker. And when people were saying that there weren't a lot of jobs, well, you see that. Where there only being 15,000 jobs created on a monthly basis when people were saying there were 150,000. That's terrible. Okay. Absolutely terrible for 2025. But now we're past 2025. Okay. Let's hope that was the worst of it. Now we're in 2026. January hit. Jobs data looked pretty darn good. But takeaway number 2, perform or exit in these companies. It is the new normal. Google is all in on AI, and they're saying you better be all in on AI or you take a severance if you work for them. This is what people are going to be saying at the companies that you work for. Block, they are on the 3rd annual layoff. Salesforce, they just cut many people from their own AI team. Blackstone, their engineers are twice as productive with AI tools. The annual performance review is no longer about growth. It is about survival. Revenue generating roles are protected, but you got to make sure you're driving sales. You're talking to your customer. You're protecting revenue. Outside of that, everything else is on the table. And this is not a prediction. This is the pattern. This is what data is showing. And this is what the data is showing by 3 companies in 3 days. Takeaway number 3. The K-shaped economy is data, and it is not any sort of theory. You guys see it. You feel it. Spotify, plus 63%. Retail sales are flat. Wages are flat. Slowest growth since 2020. Coca-Cola missed. 2 economies. Your career strategy has to account for which one you are in. So tomorrow, we're going to cover the full aftermath of the report, see what people are talking about, see what people are hooping and hollering about. I gave you guys a good glimpse of what it looks like on CNBC. But let's see what the market does. I mean, like so far, the market is green. Let's see what the Fed is signaling. And Friday's CPI report, the second punch of this week. Okay. Second punch of this week's data, 1 and 2 punch. Okay. Also, Saturdays, we have our community calls on the Patreon where we demo the AI tools that we're using, the software that we're building, the automation that we're working on. We discuss your situation, your industry, your potential next move, patreon.com/Black Heights. Okay. And if you miss any of today's show, the jobs number, the revision, the sector breakdown, the full recap will hit your inbox at 11:30 a.m. Central. It is automated. It takes the transcript from this YouTube video, uploads it, cleans it up, and sends it to your inbox. And we do it every single weekday, the full daily climb recap. The data, the stories, the strategies, straight to your inbox. Link is in the description of this video so that you can click on it and you can subscribe. Also, if this show has helped you understand what just happened with the jobs report, hit the like button right now. And if you are not subscribed to this show, because many of you guys watch the show and you're not subscribed, I don't know why you're stingy with your subscribes. Hit the subscribe button. If you're new here, you like this content, hit the subscribe button, hit the notification bell, say hello to the folks in the chat. We have some wonderful people in the chat, Ant Dog and Andre Oliver and Topaz and Big Suggs and Life of Cam and Danny and all the other folks. This fantastic individuals in here. Hit the subscribe button, hit the notification bell, say hi in the chat. You are absolutely welcome. We welcome you guys here. Okay. And one more time, if you cannot catch a live show every single morning, the newsletter gives you everything every weekday, Monday through Friday, full recap delivered straight into your inbox. Link is in the description. All right. Tomorrow morning, 7:25 a.m. Central. Right here, we're going to cover the aftermath. Like the video. Share this with somebody who needs to hear it. Hit the subscribe button. We are continuing to grow. This is Antoine Wade. Keep climbing, okay? Keep climbing. And thank you guys for staying with me during the show today. But let's see who's all in the house. Let's see who's all in the house. I like to see who's in the house. Who's still rocking with me today? Of course, we got the Life of Cam in the house. We got Big Suggs in the house. Good to see you guys. Topaz, good to see you. Kind Inquirer. Good to see you. That sounds like a new name. Wayne Yu, good to see you. Jason, good to see you. Zidyad, hi from France. Good to see you. Zidyade? I haven't seen you in here before. I'm probably saying the name wrong because I'm terrible at it. 2009 Hollywood. Good to see you. I work for a hospital. We need more staff for everything. Look at that. See? We got someone in the chat. 2009 Hollywood. Saying, hey, you know what? Healthcare is popping. She just said it just now. I love it. Cam, congratulations on your job offer, Cam. Congratulations, my man. My man, the Life of Cam, got a job offer on yesterday because he's doing big things. That's what ladder climbers do. Big things. Good to see you, Andre Oliver. Appreciate you. Wayne Yu says, thank you once again, Antoine, for another great show. I appreciate it, man. Big Sug says, thank you, Antoine. Peace to the lot of Clemens. Be safe. Keep grinding. Antoine, that needs some working on. I know, right? So, you know what? Some people do need some working on, Big Sugs. You know it is. Guys, go and have a fantastic rest of your day. It is Wednesday. Take care of yourselves. Go and crush your day. More importantly, get the work done. Be productive. Crush it. We'll see you guys tomorrow. Take care now. Bye-bye.